Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing MoneyGram stock by analyzing their financial ratios and dissecting their financial statements so we can determine if it's a buy or a sell. MoneyGram is a money transfer company. Its business is divided into two categories: global funds transfers and financial paper products. The company provides its services to individuals and businesses through a network of agents and financial institutions. It is the second largest provider of money transfers in the world. The company operates in more than 200 countries with 347,000 locations. Let's get started with the model. This is a small cap company, market cap 466 million. They're trading at $6.38 a share and they have 73 million shares outstanding. Let's look at the financials. The way you value a company is you forecast the future free cash flows and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has positive free cash flow in 3 of the 4 years. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they have negative net income every single year. And their revenue doesn't look so good. It seems to be decreasing each year. This is the company's income statement. The top line is the revenue. Below that is cost of revenue. These are the costs directly associated with generating the revenue. The difference between those two numbers is the gross profit. So you can see they had 340 million of gross profit in the trailing 12 months. That's the lowest in the past 4 years. Below that is operating expenses and then operating income. So they did have their highest operating income in the trailing 12 months, even though they had their lowest revenue. So the company is doing a better job at managing expenses. Then below operating income is the interest they pay in their debt. So you can see they have pretty high debt payments, 93 million in the trailing 12 months, which is more than their operating income. It seems to be that same trend every single year. They also have a small amount in other income and expense. So the result is negative net income every single year. 87% of their business is through money transfers, 5% is through bill payments. Then there's also financial paper products. Money orders is 4% and official checks is 4%. So a bulk of their business is money transfers. When an individual business goes to one of their locations and transfers money to somebody, you could transfer money to friends, relatives, anybody you want. These percentages have been fairly steady the past 3 years. This is a statement of cash flows, and you should look at operating cash flow because that's a better indicator of how well the company's doing. Because you don't want to see a company with negative net income, but if the result of the negative net income was higher interest payments, then at least you know the company is operating with positive cash flow, and it can fix that issue on the income statement if it sheds more debt. But if a company has negative operating cash flow, that can be a problem where they really need to start managing their expenses better. So it's good to see this company has positive operating cash flow every single year. And the way you calculate free cash flow, it's operating cash flow minus capital expenditures. Capital expenditures are investments in property, plant, and equipment. And they do have positive free cash flow in 3 of the 4 years, so that looks good. They have been issuing equity to fund their business, 83 million in 2017, then 58 million, 55 million, and 43 million. They haven't issued any more debt the past 4 years. They've been paying down debt, which is great. They paid down 10 million, 10 million, 31 million, and 29 million. This is what you want to see, a company paying down debt. Let's look at a capital structure. They have $850 million of debt, but negative 1.8 billion of net debt. Net debt is total debt minus cash. So if this number is negative, that means if they used all the cash on their balance sheet to pay down their debt, they would still have 1.8 billion of cash left over. So that's a really good sign. Now the bad thing is they have negative equity, which means their liabilities are greater than their assets. They pay 11% interest on their debt, which is really high. And they're 100% debt since they have negative equity. And their beta is really high, 2.08. So the stock is pretty volatile. It moves more than 2 times the market. And their WACC is 11%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's 461 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $506 million. We divide that by 73 million shares. and we get a calculated stock price of $6.92. They're trading at $6.38, so they're trading at an 8% discount. It is a small buy according to the model. Simply Wall Street's at $23 a share, so they're saying the stock is way undervalued. The reason my valuation is so much lower than Simply Wall Street is because my model looks at how much debt a company has. If a company has a large percentage of debt, the calculated stock price comes out a lot lower. This is the stock price the last 5 years, so you can see the stock broke through about $16 a few years back, but it's come down quite a bit. It's come up a little bit, but it seems like it's at a pretty good discount relative to its all-time high. If you invested $10,000 into this company 10 years ago, you'd have $3,100 today. That's a 69% loss. In 2012, MoneyGram admitted to anti-money laundering and wire fraud violations, because there's a lot of people who are involved in phishing scams that defrauded people out of millions and millions of dollars. MoneyGram agreed to pay $100 million to compensate the victims. And there were individuals who worked at MoneyGram who were part of the fraud, and MoneyGram obviously terminated those people. There are 1.7 billion adults that do not have access to a bank, and those people remit $739 billion a year. These are the people who really need a business like MoneyGram to send money to friends and family. Because I could just go to my local bank, but it is possible that I'm on vacation and my local bank isn't in that area, and there may be a MoneyGram or Western Union that I would use. And it's not just sending money to friends and family, it's also paying bills. These individuals have no way of paying bills because they can't just write a check like anybody else would because they don't have a bank backing that check. So they need to go to places like MoneyGram to pay their bills. MoneyGram also has digital options as well. The average age of the company's executives is 55 years, and their average tenure is 5 years. Their CEO has been with the company 5 years, and the compensation is $3.7 million. Let's look at our financial ratios. The average PE in the market is 13, the median is 14.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. The reason they have negative PE is because they have negative net income. Price of sales is stock price over sales per share. They're at 0.4, so investors are paying 40 cents for $1 of revenue. That's a really good price to sales ratio, much better than the median and average in the market. Price to book is stock price over book value per share. They're negative because they have negative equity. Equity is assets minus liabilities in the balance sheet. That's negative $240 million. And their tangible book value is negative $868 million. This implies they have a little over $600 million of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They cannot cover their interest payments with their EBIT. EBIT is earnings before interest and taxes. ROE is net income over equity. They have negative net income and negative equity, so we can't look at the ROE. Current ratio is current assets over current liabilities. They're at 13.0, so they can easily cover their current liabilities with their current assets. You generally don't need that much current assets on your balance sheet to run your business. 2.0 is fine. Anything above 2.0 can indicate you're operating inefficiently. They have $2.7 billion of cash on their balance sheet, $715 million of receivables, and $3.2 billion of other. So the company seems to be well capitalized. Their free cash flow in the trailing 12 months was positive $34 million, and they have $3.1 billion of working capital. Working capital is current assets minus current liabilities. The best way to look at ratios is to compare them to similar companies. I've done videos on Alliance Data Systems, American Express, MasterCard, PayPal, and Visa, all in the same industry as MoneyGram. And if MoneyGram has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in PE because they're negative. Their price to sales is the best of all the companies. They have a negative price to book. They have a really high current ratio, the highest of all the companies. We can't calculate the ROE. They're 100% debt. And they're really small in terms of market cap, much smaller than every other company. And they don't pay a dividend. Most companies do pay a dividend in this industry. So to summarize, I do have them trading at an 8% discount because their stock prices come down so much, so it seems like a good value. But it is a little risky because they're 100% debt and they have negative equity. But the financials don't look that bad, but the ratios are pretty weak. Let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.